Everyone. Hello. Just waiting for these two more latecomers. Just getting out of bed, Jasmine. Okay. Okay. Good morning, everyone, and welcome to this morning's session on the intersection of exploration and capital markets. I want to begin by recognizing that we're gathered today on the traditional territories of the Kwanlin Dun First Nation and the Ton Quechin Council. Before we dive into today's program, I'd like to invite you all to visit the poster sessions taking place inside the Longhouse and the Core Shack taking place in classrooms A and B during the breaks. Thank you to PDAC for sponsoring the poster session and the Tetra Tech for sponsoring the Core Shack. And a big thank you for our sponsors this morning for the Keynote, Magnet, Canada's only digital community workforce system, and due to unforeseen circumstances, unfortunately, they couldn't be here in person, but are excited to sponsor and support this year's event. I would now like to introduce our first speaker of the morning, Michael Gray. Michael Gray is with Agentis Capital. He's an equity mining analyst and partner. He's a geologist by background, and his experience includes 10 years with senior mining companies and co-founding a junior mining company. For the past 18 years, he's been a sell-side analyst, including 9 years at Macquarie Bank. Delighted to introduce his talk today entitled Disruptive Discoveries, What They Are and What Their Impact are. Please welcome me in joining Michael Gray.
Good morning. Thank you very much. I'll try to be very disruptive this morning. So what are disruptive discoveries? They're exceptional ore bodies. It could be margin, it could be size, life, it could be the impact on a community economically. So let's get right to it. We published a piece this morning, a thematic piece, about 30 pages that goes into a lot of detail. If you want it, let me know. But we've actually at Agentis, our lens has been on 6 different types. These are all drill bit discoveries. These aren't transformational discoveries in terms of technology, metallurgy, and things like that. So greenfield, brand new discoveries, transformative ones that are right near a mine, existing mining operation, extending belts, drilling deeper, the wrong rocks, which is one I love, and then breaking conceptual locks. So let's get to it. What is that greenfield poster child? It's got to be Snowline. Exceptional discovery for a number of reasons. Oops. So it's disrupted the model for reduced intrusive-related gold deposits with its exceptional grades. I think Craig Hart's here somewhere would attest to that. And we called it Fort Knox on steroids, 2 to 10 times the grades of a traditional intrusive-related gold deposit. And I think that Mark from B2 Gold would appreciate why we used the steroids. Clive Johnson said that Fekola is Masbate on steroids. So that's the inside joke there. So speaking of B2 Gold, they've validated it. Very few investments in Canada. Put in $20 million for about 5% of the company and now upped their interest to just under 10%. So we're going to talk a little bit more about Snowline later, but at the top there too, it's at an 850% return for shareholders. So that in itself is very disruptive. Let's go to transformative ones, near mines. Another company we cover is K92 down in Papua New Guinea. At one point, this was a rather small 500,000 ounces of reserves, very thin, not very good continuity, metallurgically challenging, lots of clay, lots of dilution. Barrick sold it. Along came K92 after several years and made this discovery, the core discovery, 2 times the grade, twice the thickness. And what I love is, having been there a couple times underground, these are jumbos, is a highway of mineralization, okay? Repeated corridor mineralization, giving you great continuity and subparallel veins. So 4 to 5 meters, 10 plus grams gold equivalent. It's a fantastic body. It's got all sorts of potential along strike, down dip, and maybe even towards a porphyry. In terms of its impact in Papua New Guinea, it's the #2 taxpayer amongst the mining sector there, which is pretty impressive given some of the sizes of mines. And it's had a nice, just under 500% shareholder return from it going in 2017 up to $5 now, but the stock has peaked at 10. So these are rare to find junior mining companies that make these disruptive discoveries associated with a mine. Lots of seniors make them, but you can't, they're not as disruptive. They're not as visible to the public as they are when they're in junior mining companies. Let's go to extending belts. We think a really good example, and we've used the Yukon example here, is fireweed. So fireweed, discovering the boundary zone in the Selwyn Basin, sedimentary hosted environment on the Mac Pass property, and delivering the best zinc, lead, silver intercept, mainly focused on zinc in the last 15 years, according to Brandon McDonald. So the fertile corridor that had the Tom and Jason deposits here has now been extended to the boundary zone, plus 9 other showings. So about a 30-kilometer corridor where the boundary zone is really differentiated because it's not really stratabound mineralization, it's more feeder zone discordant, giving the high grades. So, you know, the question is this the tip of iceberg? Given that's just been found, there's lots of blind opportunities. So I think Brandon's articulated that really well. So the hole that really changed everything was 124 meters of just under 15% zinc and just under 2 ounces silver. That has attracted Teck. They were there before this discovery, just under 8% or about 8%. Lundin families come in for just under 20%. Vancouver-based now Lundin family. Stock went up 41% on that discovery drill hole. Let's move on to drilling deeper. And anybody paying attention to what Filo's been doing down in the Chile-Argentine border, straddling it, they have a PFS stage porphyry project relatively high in the Andes, and they essentially drilled deeper. The project was moving along okay, but not exceptional grades for that particular part of the world, and down to depth, up to a kilometer deep. This is the hole they drilled that really stunned the markets. So about 860 meters at 1.4% copper equivalent. So that's down here below the open pit. So that probably is a block cave, and those are certainly grades that would justify a block cave. And look at the footprint now. It's 2 kilometer strike at depth down to 1 kilometer. So that's delivered just over 300% return since that discovery in 2021. And then it's up just under 700% over the last 5 years. So globally having a big impact, and we'll come back to that briefly later. So the wrong rocks, this is one I love, and I've been wrong before, and I'll give you an example here. This is Great Bear. So in the Red Lake Belt, where I have a lot of experience, a little bit humbled that Great Bear essentially drilled in the Confederation Belt and had success where the conceptual lock was or the wrong rocks were that everything's in the Balmer Formation. It's a certain package of rocks that has 25 million ounces, generally high grade. Red Lake is one of the highest grade gold belts in Canada, if not the world. And so it was in this package of felsic tuffs instead of in mafic volcanics associated with ultramafics. And so I was a little bit cynical. But this LP fault, and credit to Bob Singh, who Darwin and I have worked with before, and Chris Taylor's leadership, and John Robbins as well, they delivered a major discovery to the market. Kinross came along and bought it. Return was 900%. So that's right near infrastructure, Red Lake, but it's changed the model for what you'd be looking for in terms of the geological terrain. And finally, breaking conceptual locks. And I think one that really applies here and is a good segue to a few other things we're going to talk about is Fort Knox, with Amex making that discovery and really paving the way for low grade in North America. There wasn't another milling operation at this grade anywhere in North America at the time. So this has been in production since 1997. You can see it's produced just under 9 million ounces, and this is all tier 1. Our definition tier 1 is plus 300,000 ounces per year, and this was at a gold price of $350 per ounce. It would only really fly being close to infrastructure. This is right near Fairbanks. And you can see the milling grades in the reserves are 0.83. I think they had a high-grade starter pit at just over 1 gram, so that helped a lot. And in 2022, the reserve grade's down to 0.33, partly because they're doing some heap leaching. But that wasn't until 2009, and they had a few growing pains with it, and that was when the mill head grade had gone down. So you can see the cutoff grade is now 0.9 for the heap leach and 0.48 for the mill. And so we think that this reduced intrusive related gold deposit with that past production, almost 9 million ounces, has really paved the way for Eagle. With its successful heap leach kinetics in the Arctic, it was proof of concept, and really Eagle, Victoria Gold's done a great job to make sure that's worked properly from a heap leach kinetics point of view. The only challenge they have right now is getting tons to pad, having been to site a couple times. So that's the challenge there. But that is all heap leach at that grade of just under 0.7. But then look at Valley come along, new discovery, and according to our model, about just under 1.3 grams per ton overall globally, and about 9.4 million ounces pit constrained mineral inventory that we've estimated, and that includes a just under 2 gram starter pit. And if you remember the section I showed at the very beginning, this is right at surface. This would be an exceptionally low strip ratio, 0.3 to 1 for the starter mine, starter pit, and have extremely rapid payback. And just to follow through a little bit further on that, okay, first I've got Craig's iconic model. Where's Craig? He was here. In terms of the intrusive related model, and now, you know, we're understanding a little bit better what's happening in the cupola, and you know, or at least trying to understand why you're getting so much VG in that valley deposit. And we won't get into gory details there, but it's really transformed the eastern extent of the Tombstone Belt. So we've got Fort Knox here, we've got Eagle, Pogo here, and then Rogue has extended the endowment and the potential and the concepts. It's totally disrupted the way explorers are going to think about these deposits and not be afraid to go into a little bit more remote areas. And let's look at it from what it models up as. And normally without a resource, you wouldn't model this up so quickly as an analyst team, but it's so thick and it has so little internal dilution and it's so high grade, high margin that we feel pretty comfortable modeling it up. We call it a super tier 1. Anything over 500,000 ounces per year would be super tier 1. It's got a just under $2 billion NPV and a 40% IRR. That's throwing in assumptions on what it would take to build this. And so over 500,000 ounces per year for 17 years at pretty attractive cash costs. So there's 500,000 ounces per year on average. And here's the cost structure. Down here, about $300, and then ending up at $900. Again, just to underscore how globally significant this is, these are all the 500,000 ounce per year senior producers in red assets that they have, that they covet. And this is all there is in the world on a gold-only basis, not including some of the porphyries that have gold equivalent grades and things like that. So that's it. It's a pretty small world. Here's where Snowline sits in blue, in cyan. And the rest of these are all developers in gray. So nothing touches Snowline, according to our analysis and numbers right now, in terms of that potential. So we've got lots of time. I wanted to get through that part fairly quickly because there's a lot more detail in the report. Anybody who wants it can just ask me for it. But let's look at a what-if scenario. And what if there was a new copper gold discovery in the Yukon at this set of metal prices? And just let you think about this. What if a junior put out just under 700 meters of 1% copper? See a show of hands. How many people think that that stock might go up 25%? Okay, a few. Thank you, Mark. Like, I'm thinking as an analyst, this, depending on if it's a $25 million market cap, and I just read Neil's body language there, fair enough. $25 million market cap, this thing's probably 100 million fairly quickly. Hercules has made a discovery of about 100 meters of 1% copper equivalent. It's now a $300 million company. So that's a pretty good proxy. But let's continue with this. What if that was the context, that it was really in the guts of a high-grade core that was about 450 million tons of 0.6 copper equivalent? Just happened to be that, you got a nice grade here through a nice core of the deposit, right? So again, back to Filo. That was the intersection there. So longer at just under 900 meters and better grades at 1.4. So certainly block caveable. It needs to be, and it's in the Andes at decent elevation. But remember, this was the impact. Filo's shares went up 300%. Currently have a market cap of about 2.4 billion, I believe. Now that's partly underpinned by the PFS. So the Yukon has this discovery. Oh my God, it's Casino. So what I'm saying is, timing's everything. If Casino was discovered in the last couple of years, it would be front and center. They'd be drilling off the high grade, and this core area is where Rio drilled first. They wanted confirmation. They didn't really drill anywhere else. They wanted to understand what the rapid payback could be. And so that 450 million is in that area. They've got a low strip ratio. I think it's under the radar screen. And the disruptive aspect here is partly the impact on the Yukon economically on multiple metrics. So, and look, just as a reminder, this is the reserves. These are the resources. Reserves are included. So even though there's a 27-year mine life in the feasibility study, there's no really good reason why it's not going to go to depth deeper and go to 50 or maybe even 75 years. The resources support that. We certainly don't model it that way. Okay, let's look at Casino versus the Canadian producers, not the peer group of non-producers, but here's Casino here in terms of copper equivalent. It's number one in Canada versus Valley, Mount Milligan, and the other producers here. On a copper-only basis, it would be number two. Orange is copper. So Valley is clearly the biggest of them all. And on a cost structure, it's super competitive at $1.49 on co-product basis. So similar to Mount Milligan, nothing else really has this cost structure. You see everyone else is above $2. That's, that it's got to be built, and it needs a power solution and things like that. So fair enough. Again, I'm reading bubbles above Neil's head. Let's look at the free cash flow. Here's the cash flows. Here's the free cash flow that Casino, based on our model and our assumptions, and anyone can ask for our initiation. This is what it throws off. And this is based on $4 copper. We use 1950 for gold. We use the deflated forward curve for gold. And so, yeah, there's the debt here in blue and the CapEx in orange, and then all the operating cash flow in gray. But the thing to focus on is the black line. This is the free cash flow of $430 million per year. This is a fantastic asset, and $625 million per year in the first 10 years. So that's a 27-year mine life. You have fairly rapid payback. You've got an heap leach oxide gold to start things off. As the mill's being built, you should have some decent payback in that time. And this is one I love too. We rarely would publish the tax cash flows from an asset, but we thought in this case it was fairly important. So here we have 2030, which is our estimate of when the mine actually gets into production. This would be the heap leaching. all the way out to life of mine. In gray here is the Yukon mining royalty that would kick in. The federal income tax in blue, Yukon income tax in yellow. And you can see that really in the early years of the mine life, it's over $300 million per year in taxes. And then it comes down. Overall, it's $200 million. So thing I want to draw your attention to here is in year 2030, year 3, that would pay these taxes 30% of the casino CarMax transmission line. Because our thesis is it does get electrified. It's edgy, and it doesn't change the capital costs of building casino. It impacts the operating costs. Not only operating less on electric, but also you don't pay Joe mentioned the other day, $1.9 billion in carbon tax. That's a huge part of this. Now, it's not 1.9 discounted, but it's still life of mine. It's a big number. By 2034, 1 year later, you could pay for 100% of that transmission line from casino to CarMax. And then here's the real punchline. By 2040, you're paying for the entire line from Northwest transmission line from, say, Dease Lake to Whitehorse. Now, there could be CapEx slippage there, and it could take a few more years, absolutely, with inflation, and maybe, I think we used $2 billion as opposed to 1.7 in the most recent study. So I think it's important, given a lot of discussion on permitting in the Yukon, to look at this, and we touched on this in the short course, just on sensitivity. In this case, you can use all sorts of metrics for sensitivity. In this case, copper price, and we use $4. And then year that it comes into production, 2030 here, 2034 here, and what we put in is the net asset value of the company, sum of parts NAV. So up here, our assumption, our base case is $3.2 billion NPV. I think we've got a 7% discount rate, okay? So obviously there's a big delta. At $3 gold, you're losing $1 billion. At $5 gold, you're gaining $1 billion. That's fantastic. But the real concern, the investment community has is for every year delay, you got a slippage decrease of NPV of $250 million. We got a few minutes left. Okay, so that's really impactful to NPV. And if you had a 4-year delay, you've lost $1 billion in NPV. So this is where I think companies want to do the right thing, want to permit properly, don't want to cut corners, but they also want to be efficient for their investors and for the asset to not lose value in the asset. And I think the government should also be very cognizant because they don't want to lose tax revenue. And they want to hit as many cycles as they can. So just wrapping up here, I put the 6 disruptive discoveries, and very briefly, I've tagged a Yukon name beside it. Some of these are potential. They're not necessarily a slam dunk. But for Greenfield's Snowline, absolutely. Best thing I've seen in 18 years. I think I mentioned that the other day. Transformative near mine. The Raven deposit, sulfide high grade. That could be transformative if a mill gets built there. And it becomes a bit of a hub and spoke. Extending belts, fireweed, we talked about that. Drilling deeper, maybe Granite Creek, or there's other options. Banyan, I love any deep drilling there. Wrong rocks, Banyan in a sense. Not too often you have the gold mineralization, the Hornfelds, sediments above the intrusions. The intrusions really haven't been documented. One dike, that's it. But these are sheeted veins, so very different. Are they the wrong rocks? It could be leakage. It could be a monster deposit below. And then breaking conceptual locks, I think that's my casino point, is that this is a bit of a beast. I believe there might be one more slide. Yeah, just to sum up, I think globally, disruptive discoveries are exceptionally rare. Yukon actually has 2 in our lens, and maybe 3 if fireweed can deliver. There's a confluence of factors really helping the Yukon right now. The discoveries being made, a lot of the metal prices certainly. I think there's a decent First Nations alignment, nuance, albeit, and the government has done a lot of really good marketing. I've mentioned in our reports before that not too many conferences see a minister come down and fly the flag of a jurisdiction. And nation building electrification would be a game changer for these assets for the Yukon in general. There's my disclosure. I do own a few of these stocks. I've been talking about certainly Snowline and Western Copper and others. And we'll leave that one out. Thank you very much.
If there's time, I think we have time for one question for Michael, if anyone has one.
Mark? Sure. Yeah, no, it's a good question. These porphyries, these big long mine life porphyries, tend to have a longer payback. They tend to not have super high RRs, 20% plus minus, and yeah, they take commitment. So I think it's probably plays into the fact that Rio has obviously hesitated here. This is a $300 million company that is an absolute tuck-in for a company of Rio's size. And so there's a hesitation there. It would be a commitment. You're right. It needs infrastructure. And so I think that's just even though it benchmarks really well globally right now as one of the few assets of that scale, I think it is going to be coveted. And if there was a movement to electrify, it's a game changer. It becomes a green mine. Rio buys it in a heartbeat, in my view. Okay. Thank you.